Hi, welcome back to John Smith Shiro's. Something very significant is happening in global finance right now, and most everyday investors in the United States have no idea it is unfolding. While people are focused on stock prices, interest rates, and the latest headlines about the economy, a quiet but massive shift is happening underneath all of that noise. Countries around the world, and especially China, are steadily moving away from U.S. Treasury bonds and moving toward physical gold. And now, China is actively building the financial infrastructure to make that shift permanent and irreversible. There is a specific deadline attached to a lot of this activity, July 2026. That is when Hong Kong is scheduled to launch a brand new gold clearing system that could fundamentally change how gold is traded and settled across the entire globe. So today we are going to walk through exactly what is happening, why it is happening right now, who is involved, what infrastructure is being built, and most importantly, what all of this means for you as an everyday investor sitting here in America. Let's start at the beginning, because to understand why this matters, you need to understand how global finance works under the surface. When countries hold their national reserves, their savings, their stored national wealth, what do they put it in? For decades, the overwhelming answer has been U.S. Treasury bonds. A Treasury bond is basically a loan you give to the U.S. government. Countries buy them because they are considered among the safest assets in the world. The U.S. dollar is the world's reserve currency, meaning most international trade is priced and settled in dollars. So if you are a country like Japan, South Korea, or Brazil, you accumulate dollars through trade and park those dollars in U.S. Treasuries. That has been the system since the end of World War II, and it has given America extraordinary financial power. When the whole world is essentially your creditor, you can borrow cheaply, fund your government at favorable rates, and your currency stays strong because global demand for it never really goes away. China became one of the biggest players in this system. At its peak, China held over $1 trillion in U.S. Treasury bonds. $1 trillion lent to the U.S. government by a country increasingly viewed as America's primary geopolitical rival. For a long time, both sides benefited. China exported goods, collected dollars, and recycled those dollars into treasuries. America got cheap financing. China got a safe place to store its trade surpluses. It was a symbiotic loop. But that relationship has been changing, slowly at first, and then much more dramatically in recent years. And the change happening now is not just about economics, it is about something deeper. Since around 2022, China has been steadily selling U.S. treasuries and buying physical gold instead. Not paper gold, not gold futures contracts, not gold ETFs, actual physical gold bars held in vaults. The People's Bank of China, which is China's central bank, has been adding gold to its official reserves month after month with remarkable consistency. By the end of 2025, China's official gold reserves had reached roughly 74 million troy ounces, which translates to about 2,305 tons of gold. And that number has kept growing into 2026. At the same time, China's U.S. Treasury holdings have been falling. They dropped from over $700 billion down to around $682 billion by late 2025, the lowest level since 2008. Over just 5 months in the middle of 2025, China shed $44 billion in U.S. Treasuries in a single stretch. That is a deliberate and directional move. It is not random portfolio reshuffling. It is a strategic reallocation, and it is happening with clear purpose. Now, why would China do this? Let's break this down carefully because there are several reasons layered on top of each other. The first, and perhaps most powerful, is geopolitical risk. In 2022, when Russia invaded Ukraine, the U.S. and its allies responded by freezing approximately $300 billion of Russia's foreign exchange reserves, assets held in Western financial systems that one day were there and the next day were effectively locked. That decision sent a shockwave through the central banking world. If the U.S. can freeze the reserves of a major country, then no nation holding large amounts of Western assets can consider them truly safe if relations with Washington deteriorate. Physical gold held in your own vaults cannot be frozen remotely. Nobody seizes it through a computer screen. For China's leadership, watching what happened to Russia was a very direct lesson about the risks of financial dependence on a geopolitical rival. The second reason is dollar diversification. China has been openly vocal about wanting to reduce the world's dependence on the U.S. dollar. It is stated, Chinese policy. The dollar's dominance gives Washington extraordinary leverage because so much of global finance runs through dollar-denominated systems. China wants to chip away at that leverage, both to protect itself and to elevate the yuan as an internationally recognized currency. Gold is a direct expression of that strategy because it sits outside any single country's control. The third reason is fiscal concern. The U.S. national debt has crossed $36 trillion, and interest payments on that debt have grown into one of the largest categories of federal spending. Some economists and foreign policymakers have raised serious questions about the long-term sustainability of U.S. government finances, and China's own policymakers have publicly cited growing U.S. deficits as a reason to reduce Treasury exposure. The logic is simple. If you are worried about a borrower's ability to manage their debt, you gradually reduce how much you lend them. And the fourth reason is trade tensions. With tariffs on Chinese goods making the economic relationship more adversarial, each escalation creates additional incentive to build financial systems that can function independently of U.S. infrastructure. Now here is something that puts all of this in a much bigger context. China is not acting alone. According to data from the European Central Bank released in 2026, gold accounted for 27% of global official foreign reserves at the end of 2025. U.S. Treasury bonds, for decades considered the unambiguous foundation of global reserves, had fallen to just 22%. Gold has now surpassed Treasuries as the single largest component of global central bank reserves. Central banks across the Middle East, Southeast Asia, Eastern Europe, and Latin America have all been steadily adding gold. The World Gold Council has documented central bank buying at historically elevated levels for several consecutive years. This is not just a China story. It is a story about a structural change in how the entire world thinks about financial safety. Think about it this way. Imagine you are a country storing your national savings in a bank account denominated in a currency you cannot print or control. And recently, you watched another account holder get their savings frozen by the bank's home government as a political tool. At some point, you start looking for alternatives. Physical gold has been a store of value for thousands of years across every civilization that has ever existed. It is nobody's liability, carries no counterparty risk, and does not depend on any government's promise to maintain a system. For central banks reassessing the geopolitical landscape after 2022, those properties are not abstract. They are immediately and practically important. Now let's talk about what China is actually building, because this is where the story gets especially interesting and where that July 2026 date becomes significant. Up until now, the global gold market has been dominated by two Western centers for nearly 2 centuries. London is the biggest through the London Bullion Market Association, a 200-year-old institution that handles the bulk of global over-the-counter gold trading and settlement and sets the benchmark price twice daily. New York is the second hub through the COMEX futures market. That is essentially the whole picture. If you were a central bank wanting to buy, sell, or settle gold transactions, you had to work within Western infrastructure, with pricing determined in Western time zones by Western institutions. China wants to change that. And here is the specific infrastructure being built right now to do it. Hong Kong is constructing a central clearing system for gold called the Hong Kong Precious Metals Central Clearing Company, a wholly government-owned firm established under a cooperation agreement signed in January 2026 between Hong Kong's financial authorities and the Shanghai Gold Exchange. The Shanghai Gold Exchange, already the largest physical gold exchange in the world by trading volume, will provide technical support, help draft the regulatory rules, and has a representative serving as vice chairman guiding operations. The clearing system is modeled on the same unallocated account structure used in London, meaning instead of physically moving gold bars every time a trade settles, participants hold claims on a pool of gold in verified vaults, making transactions faster, cheaper, and more efficient. Trial operations were set to begin during 2026, with the full launch targeted for July. Hong Kong is simultaneously expanding physical gold storage capacity to over 2,000 tons within 3 years, a major investment in vaults, logistics, and regulatory infrastructure. New gold futures contracts and the Hang Seng Gold ETF have already launched in early 2026. Because the system has formal cooperation agreements with both Shanghai and Shenzhen, it is designed to integrate seamlessly with China's broader domestic financial markets. Here is what makes this especially significant from a strategic standpoint. Who is Hong Kong specifically inviting to become clearing members of this new system? According to reports, the system is explicitly targeting central banks from countries aligned with China's Belt and Road Initiative. That is, dozens of countries across Asia, Africa, the Middle East, and beyond, alongside major international banks. The goal is to give these institutions a gold trading and settlement infrastructure that does not require them to go through London or New York. Transactions can be settled in Chinese yuan rather than exclusively in US dollars. The pricing and benchmark mechanisms will eventually develop their own Asian reference rates. And for countries that have been politically or logistically closer to Beijing than to Washington, a Hong Kong-based system with Chinese government backing may simply be more convenient and more trusted than routing through Western institutions. Now, if you have been finding this video genuinely useful, take a moment and hit the like button. It really does help this channel reach more people who are trying to understand what is actually happening in the global economy rather than just chasing noise. And if you are new here, consider subscribing because we dig into this kind of structural financial analysis on a regular basis. Now let's get into what this all means for gold prices and for you personally. Here is how to think about the connection between new infrastructure and demand. When you build a system that makes it easier for a large group of institutions to participate in a market, you expand the pool of potential buyers and sellers. A gold clearing system in Hong Kong means central banks and institutions across Asia and the developing world can trade and settle gold more efficiently without routing through Western time zones, Western correspondent banks, or Western regulatory constraints. Lower barriers to participation generally mean more activity, more demand for the underlying asset. And when that demand comes from large, patient, long-term buyers like central banks rather than short-term traders, it tends to be more durable. Gold has already been on a remarkable run, surpassing $5,000 per ounce during 2025 and trading above $5,100 by early 2026. The Hong Kong spot gold market has also become dramatically more active even before the clearing system launches. Average daily turnover on the Hong Kong Gold Exchange surged more than twofold year over year as of late 2025, reaching nearly $372 million per day. The demand is already there. The infrastructure is being built to handle the volume that is coming. Some important context here. The European Central Bank noted that much of gold's rising reserve share in 2025 was driven by valuation effects. Gold prices rose approximately 60% in 2025, following a 30% rise in 2024. Even central banks that did not add a single ounce saw gold's share of total reserves increase simply because the price went up. So not every percentage point of gold's growing dominance represents a deliberate buying decision. That said, the actual purchasing trend from central banks is real, well-documented, and sustained across multiple years. Both things are simultaneously true. Gold is rising partly because institutions want more of it, and institutions want more of it partly because it has been performing so well. That self-reinforcing dynamic is worth understanding. It is also worth acknowledging legitimate risks around the Hong Kong system. New clearing infrastructure requires critical mass before it becomes genuinely liquid and functional. The period between the July 2026 launch and the point where the system has deep enough volume to offer competitive conditions could stretch for several years. Until that depth develops, transaction costs may not match what institutions can get in London. There is also geopolitical risk running in the other direction. If U.S.-China tensions escalate and result in sanctions targeting Hong Kong's financial infrastructure, that could severely impair the system's usefulness for non-Chinese institutions. Major Western banks will model that scenario carefully before committing as members. Building a new global financial hub takes time, trust, and liquidity that develops gradually. Here is a mental framework that might help you hold all of this together. For the past 8 decades, the global financial system has operated on a single hub model. The U.S. was that hub. U.S. dollars, U.S. Treasury bonds, U.S. regulated infrastructure formed the foundation everything else was built on. What we are witnessing now is a slow movement toward a world with multiple hubs. It is not a revolution. Revolutions in financial systems take decades. The U.S. hub still exists and still commands enormous weight, but for the first time since World War II, the infrastructure for a genuine alternative is being seriously constructed. Gold sits at the center of that alternative architecture precisely because it is the one asset all parties, Eastern and Western, allied and rival, can agree has value without trusting any government. So what does all of this mean for you as an individual investor in the United States? The sustained buying of gold by central banks provides structurally different demand than retail speculation. Central banks buy gold methodically in size and hold it for years or decades, a categorically different buyer profile than a retail trader who might exit a position on a single data point. When that buying is persistent and broad-based, as it has been for 3 or 4 years now, it creates a more durable floor under the market. New clearing infrastructure in Asia could also gradually shift pricing influence toward Asian trading hours, making gold a more continuously global market over time. There's also the dollar angle, which affects every American directly. If structural demand for U.S. dollars and treasuries slowly weakens as more of global trade and reserve management shifts toward alternatives, including gold and yuan-denominated systems, that has long-term implications for dollar purchasing power. A weaker dollar does not mean immediate crisis, but it can erode purchasing power quietly over years. Historically, gold has served as a hedge against exactly that kind of gradual currency weakness, and a large number of sophisticated institutional investors clearly believe in that relationship based on how they are allocating capital today. None of this is a simple or guaranteed story. Gold can and does go through extended periods of flat or declining prices. Scenarios where gold faces headwinds, a strengthening dollar, reduced U.S. deficits, easing geopolitical tensions, a slowdown in central bank buying, are all plausible. The asset went essentially nowhere for most of the 1980s and 1990s. Past performance does not predict future results. What the evidence does suggest is that the structural backdrop for gold, the combination of central bank demand, infrastructure development, geopolitical reorientation, and dollar diversification pressure, is more firmly established today than it has been in decades. That does not mean prices only go up. It means the reasons large institutions hold gold are more compelling than they have been in a long time. Here is the full picture we have built today. China has been systematically reducing its U.S. Treasury holdings while steadily adding to its physical gold reserves, driven by geopolitical risk management following Russia's 2022 asset freeze, dollar diversification strategy, concerns about U.S. fiscal sustainability, and trade tensions. China's Treasury holdings have fallen to their lowest level since 2008, while gold reserves have climbed above 2,300 tons. China is not acting alone. Central banks globally have been buying gold at historically elevated rates, and for the first time, gold has surpassed U.S. Treasuries as the largest component of global official reserves, representing 27% of total holdings, compared to 22% for Treasuries. And now, with Hong Kong's government-owned clearing system scheduled for a full July 2026 launch, the infrastructure to make this shift permanent is actively under construction. The system offers central banks and institutions across the developing world an alternative pathway for gold settlement that operates under different jurisdiction, settles in yuan as well as dollars, and connects into China's domestic precious metals markets. Hong Kong is simultaneously expanding physical storage to over 2,000 tons within 3 years, and positioning itself as Asia's primary bullion hub. For everyday investors in the United States, the most important takeaway is not a specific investment recommendation. Nobody should make financial decisions based on a YouTube video. What it is a call to awareness. The global monetary system is in a real, documented, gradual transition. Understanding why the largest financial institutions in the world are making the choices they are making, why countries are building parallel infrastructure, why physical gold is being accumulated at rates not seen in generations, helps you think more clearly about your own financial picture. Whether that means reconsidering how you think about savings, currency exposure, or simply how you read the next headline about gold, that awareness has genuine value. Speaking with a qualified financial professional who understands your specific circumstances is always the right starting point for any decisions. That is what we have got for today on John Smith or Two. If you found this breakdown valuable, please share it with someone who you think would benefit from understanding what is actually happening beneath the surface of global finance right now. Drop your thoughts and questions in the comments. I read them and genuinely enjoy hearing what is on your mind. We will see you in the next one.